This episode is brought to you by Progressive Insurance. You chose to hit play on this podcast today. Smart choice. Make another smart choice with Auto Quote Explorer to compare rates from multiple car insurance companies all at once. Try it at progressive.com. Progressive Casualty Insurance Company and Affiliates. Not available in all states or situations. Prices vary based on how you buy.
It's that time of year again. When you start arranging pumpkins on the stoop, try out a new cranberry sauce recipe and plan out a tablescape that'll outdo last year's. In other words, it's when you break out all your DIY holiday skills. And now, ADT is making it easy to DIY your home security too. Their systems aren't just simple to set up, they also fit within your budget. So get excited for your next project, because your peace of mind just went DIY. Visit ADT.com or call 1-800-ADT-ASAP. When every second counts, count on ADT.
Welcome back to another episode of Investies. I'm your host, Linda Garcia, Texas State Representative and author of the book Wealth Warrior. This week on the podcast, we are going to review how some of the biggest tech companies performed and an unexpected surprise in their earnings reports. But before we get into that, let's go ahead and look at the market's performance overall for last week. So last week, we reached another new all-time high with the Dow coming in at 1.7% increase, the S&P 500 coming in at 1.72% increase, and the NASDAQ coming in at 3.76% increase, which really isn't a surprise there. We did have the tech companies that reported, and so some of these companies are really what carried the market. We also had the rate cut by the Federal Reserve last week, with a 10-2 vote from the Federal Open Market Committee that lowered interest rates by 0.25%. This 0.25% drop will help them meet a benchmark borrowing rate range of 3.75 to 4%. So the 0.25% is simply giving banks a specific range at 3.75% to 4%. The Federal Reserve does not meet in November. It doesn't meet until December, right before the end of the year. And Fed Chair Powell did set a certain expectation where he is letting us know that we don't necessarily have a slam dunk for another rate cut. This did sort of upset the market, given that they have been pricing in multiple rate cuts to come. Powell said in the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. So he does come through a bit hawkish there. We also have to remember that we did get CPI data because we are required this data, even though we have a shutdown, so that we can distribute appropriate checks for Social Security. And the CPI data determined that we are still not near the 2%. We are at a 3% increase in inflation year after year, and we have been this way for 5 years now. So I think that this is fully understandable that he is giving us a signal that we shouldn't necessarily look for a rate cut next month, in the month of December. As a reminder, the Federal Reserve has two goals, also known as a dual mandate. One of those goals is to make sure that we have a strong job market. And the second goal is to make sure that they maintain inflation at a 2% rate. And the only tool it has to combat inflation is to increase interest rates. This is why him and Trump have so much friction with one another, because Fed Chair Powell is focused on his dual mandate. Meanwhile, Trump wants to make sure that there is more liquidity in the market. More liquidity in the market does mean higher inflation. And while that does benefit the middle class and, of course, the top 10%, this does greatly impact our lower income communities, which is the community that we should always be thinking about first. These are the people that are at the heart of our infrastructure. And if they are suffering, we will eventually suffer as well. Not to mention that inflation also begins to deteriorate the middle class, which is what we have seen take place in the last 5 years. If you want to get real-time updates on how the economy is performing and any news that you want to be alerted about to help you make decisions on your investing journey, then I highly recommend that you join our community over on Patreon. We have different tiers to help fit different budgets and, of course, different needs when it comes to support on your investing journey. Head over to patreon.com/Investies to choose the tier you would like to join. And we have a free trial for 7 days. You can go over, check it out, and see if this is the right community for you. Patreon.com/Investies.
A mochi moment from Mark, who writes, I just want to thank you for making GLP-1s affordable. What would have been over $1,000 a month is just $99 a month with Mochi. Money shouldn't be a barrier to healthy weight. 3 months in, and I have smaller jeans and a bigger wallet. You're the best. Thanks, Mark. I'm Myra Ahmed, founder of Mochi Health. To find your Mochi moment, visit joinmochi.com.
Mark is a Mochi member compensated for his story.
Monday Sidekick, the AI agent that knows you and your business, thinks ahead, and takes action. Ask it anything. Seriously. Monday Sidekick, AI you'll love to use. Start a free trial today on monday.com.
Last week, we had some of the biggest tech names report their earnings. And while the majority of them last week all reported beats on earnings expectations, there was a surprise in the mix. Now, analysts were not expecting the amount of capital that is being spent on the infrastructure of AI. I was not expecting that, but I'm not an analyst, so I was a bit surprised that the market was surprised and did not anticipate this expense. So really quickly, let's just go over what a capital expenditure is. A capital expenditures specifically for tech companies that are publicly traded are funds to acquire, upgrade, or maintain long-term assets like technology infrastructure, data centers, equipment. These are all strategic investments in the company's future and growth and operational capacity, recorded as assets on the balance sheet rather than immediate expenses on the income statement. So last week, tech companies began to report this, I guess what you could say exuberant, because it was unexpected, amount of capital expenditure for AI infrastructure. And analysts then became on high alert with every single tech company that reported and paying close attention to the capital expenditures. Now, typically, when a publicly traded company beats their earnings per share and their revenue that analysts have anticipated for them to beat, it is expected, or I guess I should say normal, to see that publicly traded company to perform well that day or for the next few days or weeks in the market. We normally tend to see growth unless there is a change that can potentially affect the future of its revenues and its earnings per share. An example of that is their forward guidance. If a publicly traded company reports a beat on their earnings per share and expectations, but they change their forward guidance, meaning what they expect to take place for the remainder of the year, then that publicly traded company does in fact get punished in the market, and we will see that company begin to decrease. We will see it come down a leg or two and test its level of support. That's really important for us to see those types of tests. And this is normal to happen every once in a while, especially as we're dealing with some unexpected situations, like, for example, right now, tariffs. If publicly traded companies are anticipating the impact of tariffs but have not yet had them, then it would be normal for them to change their forward guidance. The market, however, does not like the instability of not being able to determine what will happen. So while tech companies are not necessarily changing forward guidance, which I think they should be, but that's not the way it's being communicated. They do have an influx of capital expenditures that was a surprise. So now the question becomes, how will capital expenditures impact tech companies quarter after quarter? And I think given that these capital expenditures were unexpected, I personally feel like, now I haven't heard this in the market, but I personally feel like there isn't necessarily a way to determine the cost of this. I think they have to go through the motion of implementing, gaining the experience of implementing, and then perhaps better determining how much they are going to spend on the infrastructure. That is my guess. The point here is that there was a big surprise. Analysts were not expecting this. And so now, moving forward, we are going to begin to watch this closely. Do I personally think that this is a long-term concern? No, I don't. However, I could be wrong. It could be a long-term concern. I'm looking at this from the perspective of, we know technology to depreciate. Technology eventually becomes cheaper, and whatever the future technology is, it becomes a household product. So one of the examples I gave when I was breaking this down from my perspective over on our Patreon group was I was sharing that I do believe in the future we are all going to have our own clouds for our households. Right now, of course, we have cloud centers where big corporations are the owners of the cloud. But I do think the way we moved into having internet in our homes, into having televisions, at one point only for the rich, and now televisions in every single room in our homes, even in lower income communities. I do think that this is how this is going to accelerate in the future. This is just my perspective. Now, the reason why technology overall is such a big economic driver is because technology does in fact depreciate. It does in fact become cheaper and more accessible. And so the lower cost of the product along with the efficiency can garner us economic booms. And we get to see that every single day. Who would have thought 20 years ago that YouTube, the application, was going to birth hundreds of thousands of millionaires and create an entire new economy? Who would have thought that podcasting would create a whole new economy of millionaires as well? This is the ability to use these technologies at a very low cost, low impact, start from our home and produce a product out of thin air without any restrictions. And so to my point here is, while we are seeing the expenses of infrastructure and that is going to impact the market, I think for short term, who knows what short term is? It's all relative. For example, Netflix did not become profitable until I think it was 2021. And the entire time as I was an investor in Netflix, so many folks that were in the finance industry or accountants would tell me, you need to get out of that because that company is not profitable. But what they didn't understand is it takes capital in order to build a competitive company. You have to continuously reinvest and reinvest. That is what Netflix was doing as it was creating its own content, its own infrastructure in technology. And, eventually it becomes profitable. I think the beauty of what's taking place now is that a lot of the companies are, in fact, already profitable. And so it's not much of an impact per se, that they are not in their startup stages. They are much more mature companies. And so they can take the brunt of the cost. I think it's more concerning, in my opinion, as an investor, if these companies did not have capital expenditures in building the infrastructure of AI. So basically, I would be much more concerned if we didn't see this line item versus actually seeing the line item. We did see some of these companies come down after they reported their capital expenditures. I think the market is still trying to process this information. Some other news that we received in the market was that Netflix is splitting their stock 10-1. I'm so excited about this stock split. I've been waiting for this stock split for some time. I got to be part of their second stock split in 2015, where they split 7-1. At that time, I didn't know what a stock split was. It was through that stock split that I actually learned. Let me explain to you quickly what a stock split does and how it impacts the company. A stock split, let me use this one for example of the 10-1 that Netflix is going to do, which is going to take place on November 14th. For every one share you own of Netflix, you will acquire 9 more shares. That doesn't change the price of the share, it just divides them. Let's say that right now Netflix is trading for $1,000. Currently, it's trading for a little more than $1,000, but for math purposes, it's trading for $1,000. You have one share. They give you 9 more shares, and those 10 shares, the 9 that you acquired and the 1 that you purchased, are all worth $100. What does this do for the stock itself? So what it does is it makes it more appealing to retail investors. It makes it feel that it is more affordable. So what tends to happen is we will see an influx of retail investors purchase more stock. And by default, that does bump up the growth of the stock. It just does. Now, hardcore fundamentalists, and I talk about this in my book, Wealth Warrior, hardcore fundamentalists hate stock splits. CFOs hate stock splits because it doesn't change anything fundamentally to the company. It is just this mind trick, and people tend to flock to the stock and purchase more. So I am excited that this is taking place. Maybe it's because I am looking at it from someone that has been I've been poor. The majority of my life growing up, I have been poor. And so I look at it from that perspective of the ability of people purchasing more and the shift that it creates when the stock price looks more affordable. What's funny here is that I have been getting intuitive hits that the stock was going to split. I went as far as trying to do some research on how and if and when the stock would split. It was really dumb research, but I just had to get it out of my system. Recently, Netflix had a change in CFOs. And what I did is I researched all of the companies that the CFO used to be a CFO at. And I checked to see if under his responsibility, he applied stock splits. And to me, if he had, that made it more likely for him to implement a stock split at Netflix. When the 2015 stock split took place, our CEO really pushed for that. I think he was thinking about it the same way small retail investors are thinking about it. It just feels more affordable and therefore will drive more traffic to the purchase of the stock. While I vividly remember the CFO being very upset and being vocal at our all hands and stating that he was not in favor of this, but what can you do when your CEO and founder of the company really wants it to happen? So that is taking place. If you're an investor in Netflix, you will see that change happen on November 14th. And hopefully we will reap the benefits of an increase in price and see that gain in our portfolios. Thank you so much for listening to this week's episode of Investies. Next week, we are going to have Eliza on the show. Our goal is to talk about the government shutdown and the impact that it will have on the economy as we are potentially hitting the mark where we will have the longest government shutdown in history. The last government shutdown that had been the longest in history was in 2019. This was also under Trump's administration. Don't forget to subscribe to Investies podcast to be alerted every time a new episode is published. Thank you so much. You are listening to Investies, a Cosmic Standard production. I'm your host, Linda Garcia. A very special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.
DSW, Designer Shoe Warehouse, is the one-stop shop for all your footwear needs. With sneakers, boots, and everything in between for every style, mood, and occasion, you'll definitely find shoes that get you at prices that get your budget. DSW has what you need, but more importantly, they have what you didn't even know you wanted. You never know what you'll find at DSW. Find the shoes that get you at prices that get your budget at DSW stores or DSW.com.